Hello and welcome to the look ahead for the week beginning Friday, Monday the 16th of June with me, Fiona Singota, Senior Market Analyst at City Index. So just as always, I'm just going to ask you to read through the risk warning for a few moments. I will put myself on mute whilst you do. Okay, so brilliant. We'll just crack on then. Let's start as always by having a quick look at what's been going on in the stock markets this week. We've had the US S&P 500. It's actually flat on the week. As the markets have had quite a lot to weigh up again this week. So first of all, the expectations, well, we were looking at developments surrounding the US Trump's trade tariffs. So we saw that China and the US agreed a deal, although I have to say there was sort of relatively scarce details surrounding that deal, and it appears that we're just back to where we were post the Geneva Agreement. So that's 10% tariffs on goods entering US goods entering China, and 30% tariff on Chinese goods entering the US, which if you add to the 25% from previously, that's now 55%. But the market was a little bit spooked by news that Trump was sending out letters regarding unilateral trade levies, which are going to be applied on those countries that haven't agreed trade deals, which are actually quite a few. So the concerns over what those unilateral tariffs would be just unnerved the market. And then obviously today we've got the development, the escalation of tensions between Israel and Iran, which is weighing on risk sentiment, boosting oil prices, and safe haven demand as well. I'm just going to pull up oil actually, because I think over the weekend it's going to be, the market's going to be watching very closely what happens as far as any developments in Iran and Israel are concerned. If we just have a look here, if we actually just scroll out to a weekly chart, we can see, look, there's this pattern. Oops, the daisy, there we go. The oil has been trading in, so this downward channel that oil has been trading in over this sort of quite a fairly extended period of time, just reaching to the upper bounds of that level with the spike higher. And the outlook, if the escalation continues, is obviously for oil potentially to continue rising. So this is where we are now. Obviously, it's risen from those 55 lows that we were at previously. Didn't quite make it to the high that we saw in January, so we're just shy of the 2025 high. That's going to be the next level on the upside. Worth seeing that we do have this long upper wick on today's chart. We did actually see oil prices surge 11% higher, which was marking the strongest increase in oil since the Russia invaded Ukraine. But we haven't managed to hold on to those higher prices. So also very, very overbought here, potential for some comeback. Levels to be watching, you've got this level here, which is on the downside, 71.80. That's the levels to be watching on the downside. And you've also got the 200 SMA, we've got 70 in there, and then the 200 SMA at around 68.70. On the upside, buyers are going to need to get above that 77.50 level to bring the 80 level back into focus. But if we do have ongoing escalation of tensions, that could see oil prices rise. However, if we see the situation start to cool off, then that could bring oil prices back down towards those levels that we've just been speaking about. Other one just to watch here for is gold as well, because gold is rising back up towards that all-time high. So we've risen above this 34.40, the 34.33 level that we saw in May. We're above, so we're now above that at June high. And that sort of continue potentially to be trading towards that 3,500 fresh. That would be the all-time high in April. I mean, there's nothing in this chart which is telling us that it's going to be sinking lower. We're not overbought. If we get a close above that level there at the 34.35 level, then that would be bullish for a move up to the record highs. So, I mean, because not only have you got the uncertainty over developments of over the weekend, but you've also got sort of, you know, we've got rising uncertainty as we move towards sort of, you know, that July 9th key date as far as Trump's tariffs are concerned as well. So there's a little bit of uncertainty and nervousness which is drawing in for those. But I mean, just getting to the economic calendar now, there's quite a lot going on. So we've got data from China, we've got the Bank of Japan interest rate decision, US retail sales, UK inflation, FOMC, Bank of England interest rate decision, as well as the SNB rate decision. So there is a lot going on next week. Now, I think we're going to just start here with the Federal Reserve. So let's take a look then just at what's going on with the NASDAQ. This is another interesting chart. Okay, so Federal Reserve next week. Federal Reserve is not expected to move on interest rates, so we're expecting them to leave interest rates unchanged. This is the decision on Wednesday. And that'll be at the 4.25 to 4.5%, where rates have been since the central bank last cut in December. So we're going to see Federal Reserve Chair Jerome Powell and co continue to weigh up concerns over the weakening labour market and still above target inflation. So if we think about since the last meeting in May, non-farm payrolls have fallen further and US inflation has ticked up to 2.4% just this week. We saw that, although that was actually cooler than feared. But the market's going to be looking for any signs that the Fed is more concerned about one of its dual mandate, inflation or jobs, than the other, and what that might mean for the path of interest rates. As well as the rate decision, we've also got the Fed's projections regarding monetary policy. So the dot plot, as well as the projections for growth and inflation. Last one was done in March, and this is going to provide clues as to where the Fed sees the path of rate cuts going. Currently, the market is pricing in 2 rate cuts by the end of the year, the next one expected in September. Now, if we have a slightly more dovish sounding Fed, because if we think the data this week hasn't been necessarily that favorable. We've seen PPI inflation was just 0.1% month on month. CPI, as I mentioned, was still down at 2.4%, weaker than expected at 2.5%. And then the jobs data, jobless claims unexpectedly rose as well to 248,000. So that comes after the non-farm payrolls that were down at 139,000. So there is a sense that there is some weakening in the labour market. So if the Fed latches onto that and sounds a little bit more dovish, then that could be beneficial for stocks. This is the NASDAQ. As we can see, you know, it's just trading modestly down from record highs. We've found that it actually found support today. So this is the rally that we've had from that low in April of 16,325, rallied to a high of 22,000 yesterday. Now we've seen that sell off today. We've seen some weakness. Has recovered from the low of 21,500, which is also the 20 SMA, and we are sort of not down as badly as we were previously. Just be careful, I was going to say, for slowing momentum here. It does look like we're seeing a little bit of RSI divergence, but there's no strong signal, concrete signal that this is reversing yet. So potentially could be looking for a move towards that all-time high of 22,225. But next week is a fairly big week as far as potential headline risk and as far as central banks are concerned. So maybe the market may struggle to get there unless there's sort of a really sort of diversive or notable dovish stance from the Fed, or if everything turns out to be hunky-dory in the Middle East over the weekend, which I potentially think is unlikely at this stage. The other thing we're going to be talking about now is the Bank of England. So the Bank of England is another big interest rate decision that we're going to be watching for next week. Comes as the pound rose to a fresh multi-year high of 136.20 yesterday, but has fallen lower today. But still, that uptrend is very much intact. Okay, so the Bank of England is expected to leave interest rates unchanged at 4.25% on Thursday. Now, the meeting comes as UK inflation jumped to 3.5% in April, up from 2.6% in March. Now, let's not forget that we do have UK inflation data, which is out prior to the interest rate decision, and we don't have expectations out for it yet, I don't believe. Let's double check here. Here we go. Yeah, we don't have expectations out for it yet, but inflation in the UK is sticky at that 3.5% level. We're also seeing those signs of the UK jobs market cooling. We saw unemployment this week rose to 4.6% and wage growth dropped by more than expected to 5.2%, down from 5.6%. Now, this is still elevated and it's not really consistent with inflation falling to the 2% level, but it is a move in the right direction. Meanwhile, the growth outlook is also deteriorating in the UK. We had GDP this week, which showed a contraction of 0.3% in April after growth of 0.7% in the first quarter. Now, whilst there are still ongoing concerns over inflation, I think the Bank of England is unlikely to ramp up the pace at which that it's cutting interest rates, and I think that is likely to overshadow any concerns over growth in the labour market for now, until there is more of a potential slowdown showing through. The market is currently pricing in 2 rate cuts by the Bank of England by the end of the year, 1 per quarter. Now, if this is, I said, sterling US dollar, very much still in that uptrend, signs of slowing momentum here. But no sign with the bearish divergence, but there's no sign of a reversal up here yet. So that's something just to be watching out for. But whilst we're being guided higher by the 20 SMA, then potentially the next level to watch for on the upside is going to be 137 and 137.50. If we see continued weakness, for example, an escalation of tensions over this weekend, and a more dovish sounding Bank of England next week, then levels to be watching out for can be seen here. This is that 134.50 level, which was the high that was back in late April. Below that, you've got 133, which comes into focus. If we hear that an improvement in risk sentiment, an improvement in risk sentiment could see the pair move up towards that 137.50 level. Now, just whilst we're talking UK, let's have a look at what's going on with the FTSE, because the FTSE was also just very, very close to record highs. Didn't quite got there. We got up to 8,900, and that was yesterday before it's falling lower, but still in that uptrend. That's the next level to break. We'll get an improvement in risk sentiment. Obviously, the pound is, the FTSE is very much boosted by oil majors. So any sort of increase in Oil prices could be beneficial, but obviously there are still lots of other sectors which may not be so much benefited. But also the defence sectors could also, which have performed particularly well and been a big part of this rally, could also continue to do well if tensions continue to escalate over the weekend. Level to watch on the upside, 8,900. That would create fresh all-time highs and bring 9,000 into focus. Near-term support, 8,800. That's the sort of support level that we're seeing here, and then also the 20 SMA break below there, and that brings you down to around 86.50 level. Other thing to keep in mind with the FTSE is the China data that we have. We've got Chinese retail sales and industrial production. Now, these are going to be watched quite closely. Obviously, this can affect markets such as the FTSE, which has exposure to miners, also luxury stocks, and then also oil markets can be impacted by this data as well. And then you've got the Hang Seng, which we'll take a look at shortly. Basically, the Chinese economy, well, this is going to provide us some insight as to how it fared whilst we had that sort of tariff roller coaster in May. Domestic consumption is expected to have weakened again, whilst industrial production and fixed asset investment are expected to hold steady. But retail sales growth is a key gauge for consumption and probably slipped below the 5% level, down to 4.9. So this is what we're going to be watching for. Weak data obviously could just raise concerns over what these tariffs are meaning as far as the Chinese economy is concerned. This again, you know, in this similar pattern that we've seen with the US counterparts, we've risen above this level here, but we've had a pretty strong rally from those lows that we saw here back in the 18,830 level. Strong rally to a peak here of 24,400. Just falling back now because of this risk-off mood that we're seeing across the financial markets. Levels we're watching here is around the 23,400. That was the high that we saw in 2024. And then below there, you've got the 50 SMA at 22,600. But that's if we do get this continued ongoing risk off, and obviously any escalation in the US Trump-China next week could also impact the stock. But otherwise, look on the upside. The uptrend is still intact here, and the levels we're watching on the upside will be 24,900. So let's see, what else have we got? Bank of Japan. Let's get on with the Bank of Japan. So Bank of Japan are not expected to move on interest rates again. They are expected to leave rates unchanged at 0.5%. But interestingly, I think a lot of what goes on with the Bank of Japan, because we're seeing sticky inflation, stronger inflation, we're seeing growth. So it'll be interesting to see what the Bank of Japan's take is, I think, as far as trade talks are concerned. That's going to be an area that they're going to continue to monitor developments and negotiations to see what's going on. You know, should tariffs measures turn out to be less disruptive and for underlying prices, then this could actually support the discussion of further rate hikes for the Bank of Japan. And it could, I mean, they'll be looking for more clarity over tariffs and the global trade situation, which they could have, which they'll probably want before they raise raise interest rates again, which is expected before the end of the year. Japan's top negotiator will arrive in Washington today for a 6th round of talks at the G7 and then ahead of the G7 summit in Canada. Recent growth in Japan has been slightly stronger than expected earlier in the year, and that relative strength has meant that we've seen inflation accelerate to 3.5%, or core inflation at least has accelerated to 3.5% in April. So if we get a slightly more hawkish sounding Bank of Japan, that could give the US dollar, Japanese yen a pull lower as the strengthening of the yen. This is interesting because it has been trading in a pretty much of a holding pattern, I would say, for most of the past couple of months. We did get one spike higher, but we're still very much in that holding pattern. I think on the downside, we're finding that support around the 142.50 level. If we get US dollar weakness, then that could take out that level, in which case that we can see a fall back towards the 140 level. And on the upside, if we're getting it slightly more dovish Bank of Japan, or any concerns about those trade talks, then we'll be watching on the upside for 145. A rise above 145 brings the level 146 into focus. Other thing we're just going to have a look at here is Euro US dollar, just because, I mean, this has very much been a trade headline, one to be watching. You know, the Euro US dollar has had a very strong rally. We saw it rise back up to the level of 116.37. So we can see that here as well. We've had a strong recovery. The price hasn't held above that, as we've seen that dollar strength come back, which is putting the pair back towards that 115 level, but it hasn't broken below 115. So there is a potential move for this to remain higher. We haven't seen any concrete sign of a reversal. It'll be interesting to see whether it stays above 115 into the close today. That's what we'll be watching for as an encouraging sign that the potential move back above the 115.80 level. On the upside, 116 is the next logical level for this pair, as the euro has really benefited from this US dollar sell-off that has become really quite acute over the past few weeks, as the market sells out of the US dollar with Trump in charge. So that is everything for me. I hope that you've liked what you've seen, and if you'd like more videos like this, then please do subscribe.